The world is changing. Fast. Consider this one fact. Global clean energy jobs could reach tens of millions in the next decade. That is more than a statistic. It is a signpost. It points to a massive shift in how we live, how we work, how we power our world. When big changes happen, money moves. Opportunities follow for those paying attention. Many people want to find the best places to put their money. They want their savings to grow over time. It's about building a better future for yourself and your family. The key is not to chase quick wins. It's to understand the big, slow-moving tides of change. This essay will look at 3 such tides. Large trends that could grow over the next 10 years. The first, clean energy. The second, artificial intelligence and cloud computing. The third, infrastructure build-out in emerging markets. These are not stock tips. They are ideas, starting points for your own thinking. The goal, help you understand the story behind each one. Investing isn't just numbers on a screen. It's the stories of change that drive those numbers. We'll use simple words, no complex jargon. I'll explain each theme clearly and why it could grow this decade. We'll also cover simple ways to invest, from individual stocks to broader funds. Most importantly, risk. Every investment has a downside. This won't tell you what to do. It will give you a framework to think and make informed choices. The coming decade will be defined by transformation. So, what exactly is clean energy? It is a simple concept with big implications. Clean energy is power that makes little to no pollution. Think of the sun hitting a solar panel, or the wind turning a giant turbine. These methods create electricity without burning fossil fuels. But the idea is bigger than just solar and wind. Massive batteries store power for when the sun isn't shining. The entire ecosystem of electric cars. The vast network of charging stations to keep those cars running. A complete reimagining of our energy system. Governments around the world are pushing for it, setting ambitious carbon-cutting goals, backed by new laws, new regulations, and billions in subsidies and investments. Companies want to be seen as green. Switching to clean power creates huge, sustained demand. Technology has gotten much better and cheaper. Solar panels and batteries cost far less than a decade ago. Clean energy is going mainstream. More electric vehicles on the roads every day. Countries announcing massive new wind farms, rebuilding a huge part of global infrastructure. Massive build-out creates economic activity. It creates jobs. It spurs innovation. It drives demand for raw materials. It drives demand for manufacturing. It drives demand for services. Momentum is strong and likely to accelerate over the next decade. Real-world example, a major electric car maker. A decade ago, their vehicles were rare. Today, their sales have surged worldwide. They are now one of the most valuable car companies. Why? Technology improved. People wanted the product. Government incentives helped. Similar story. Large solar companies building projects. Their sales and stock prices have grown as solar demand exploded. These are not isolated events. A global energy transformation. Of course, no investment is without risk. The clean energy sector is no exception. The good news is that there are many ways, from the direct to the indirect. The most straightforward path is buying stocks of individual companies, solar, wind, electric cars, or the lithium behind batteries. This approach requires research and the risk that a single company might fail or be disrupted by a competitor or new tech. A simpler way is through exchange-traded funds, baskets that hold many stocks. Clean energy ETFs can span solar, wind, and EV companies, automatically diversifying your investment. Beyond stocks and ETFs, some look to green bonds that fund projects like solar farms or public transit, paying interest over time. New factories can lift local housing demand, an indirect play via real estate. Technology shifts can obsolete incumbents. Policy can change. Many firms are young, and stocks can swing. Finally, the prices of key raw materials, like lithium and cobalt for batteries, can swing wildly, impacting profitability. Let's move to our second major theme. It is a duo that works hand in hand: artificial intelligence, or AI, and cloud computing. AI is computer programs that can learn, reason, and make decisions based on data. It is the intelligence behind self-driving cars. It is the intelligence behind voice assistants on your phone. It is the intelligence behind the recommendation engine that suggests what you should watch next. Cloud computing means using powerful, remote servers to store, manage, and process vast amounts of data. The cloud provides the power and storage modern AI demands. The potential for growth is immense as these technologies become essential. Banking, healthcare, retail. A bank might use AI to detect fraud, a hospital to help diagnose disease, a retailer to manage inventory and predict demand. Efficiency and innovation create relentless demand for AI tools and cloud power as the world generates more data every day. Big tech invests tens of billions to build cloud infrastructure and AI. They rent it to startups and giants alike, creating steady, recurring revenue, like being landlord of the digital economy. A major cloud provider grew a small side project into a profit engine as businesses shut down data centers and moved to the cloud. The most direct method is buying the stocks of the dominant companies in the field. This includes the giants controlling cloud and the firms designing and making advanced chips, the essential hardware for AI. This concentrates your investment in a few players. For breadth, ETFs again offer a simple solution. There are ETFs for cloud services and infrastructure, AI-focused funds across industries, even robotics or cybersecurity. Broad index funds like the S&P 500 or the NASDAQ 100 also give exposure since tech giants are top weights. For hands-off investors seeking diversification and minimal effort, broad, low-cost index funds are excellent. The biggest firms face regulatory scrutiny, lawsuits, and fines. The chip industry cycles boom to bust, and societal concerns like job displacement or bias could slow adoption. It's important to weigh both the opportunity and the risk before deciding how to own a piece of the cloud and its mind. Our third and final investment idea shifts our focus geographically. It is about emerging market infrastructure. Emerging markets grow quickly, but aren't fully developed. Infrastructure is the skeleton of a modern economy. Roads, railways, airports, power plants, water systems, internet networks, 5G networks. It is the foundation upon which everything else is built. Large, young, growing populations move to cities, needing housing, offices, and transport. As middle classes grow, demand for electricity, internet, and reliable public services rises. These countries race to build what developed nations built over a century. It requires staggering investment, creating long-term demand for construction, materials, and engineering. With supply chains diversifying, new locations need ports, highways, and stable power, spurring private and development bank funding. Imagine a large Southeast Asian country building high-speed rail, jobs during construction, easier travel and shipping after. A builder secures years of revenue. A bank financing a port or power plant earns steady returns. Investing in the growth of distant countries might seem complicated, but there are several well-established ways to do it. One of the most common methods is buying ETFs that target emerging markets, broad, country-specific, or regional funds. These funds provide instant diversification, reducing single company or political event risk. You can pick firms positioned to benefit, construction and engineering, local banks, or multinationals with big EM operations. For income, EM bond funds, government and corporate, often pay higher yields. But currency swings, political instability, policy shifts, weaker legal systems, and corruption raise risk. These markets require a long-term perspective and tolerance for volatility. No investment is ever a sure thing. Each of the three powerful ideas we have discussed, clean energy, AI, and the cloud, emerging market infrastructure, each has reasons to grow and each has risks. The most important rule, don't put all your eggs in one basket. A simple way to diversify, use ETFs or index funds. Always keep some safe, accessible cash for emergencies. Time is your greatest ally. Prices can drop suddenly for reasons unrelated to long-term health. Over 10 years or more, performance follows underlying growth. A long-term mindset helps you ride out bumps. How to put this together? First, be honest about goals and risk comfort. Investing for retirement in 30 years? or a down payment in 5? The answer changes everything. Next, choose a mix that feels right. Example, 40% S&P 500, 20% clean energy ETF, 20% cloud computing ETF, 20% emerging markets ETF. This is just an example. The next decade promises to be a period of profound change. These are not just headlines. Deep, powerful currents, clean energy, AI and cloud computing, emerging market infrastructure. They are supported by strong long-term tailwinds. But potential is not a guarantee. Every opportunity has risks. Understand them before you invest. The path to successful investing isn't secret tips or bold bets. It's simple, consistent actions over a long period. Use low-cost, diversified funds. Pay attention to costs and taxes. Use tax-advantaged accounts, 401k, IRA. Start with an amount you're comfortable with, even if it feels small. The habit matters more. Compounding is a snowball rolling down a long hill. Your job isn't to predict the future, it's to position for progress and protect against setbacks. Stay curious, but don't let perfection stop you. Good enough beats perfect. The single most important thing you can do is take the first step.